Welcome and thank you for joining today. We are about to explore the best indicators for volume analysis. These tools are essential if you want to make smarter trading decisions. By the end of our session today, you will know all about the top volume indicators, and you will have a good understanding of how to use them effectively to identify trends, confirm breakouts, and time your entry and exit points with confidence. Before we dive into the details, let me ask you a question. Have you ever wondered if there is a way to see what is happening behind the price movements? Imagine having an indicator that can show you where the real buying and selling pressure lies, giving you an edge in predicting what might happen next. Well, that is exactly what on-balance volume can do. Let us jump right in with the first indicator, which is called on-balance volume. On-balance volume is a momentum-based volume indicator that tracks the cumulative buying and selling pressure over time. It does this by adding the trading volume on days when the price goes up and subtracting the volume when the price goes down. Now, here is why this is important for you. If on-balance volume is rising along with the price, it signals a strong and healthy trend. But if on-balance volume begins to move in the opposite direction of the price, that is often a sign of a potential reversal. It can indicate that there is hidden buying or selling pressure that is not always visible just by looking at the price chart. One important chart pattern to watch for in conjunction with on-balance volume is the flag pattern. Flag patterns are periods of consolidation that occur after a significant price move, and they often result in a continuation of the prevailing trend. If you see a flag forming and on-balance volume is still trending in the same direction as the preceding trend, it suggests that the trend may continue after the flag breakout. If on-balance volume diverges during the flag, however, it could be a warning that the breakout may not be as strong. Another key pattern to use with on-balance volume is the pennant pattern. Pennants are similar to flags, but are characterized by converging trend lines. When a pennant forms after a significant price movement, watch on-balance volume closely. If it continues to move in the direction of the price, it serves as confirmation that the breakout will likely have strength. If on-balance volume declines during the formation of the pennant, this could indicate weakening momentum. The wedge pattern is also highly informative when analyzed alongside on-balance volume. Rising wedges are typically bearish and indicate that upward momentum is slowing, which can lead to a reversal. If on-balance volume starts to decline while the price is forming a rising wedge, this is a strong indication that selling pressure is increasing and a bearish reversal is likely. On the other hand, a falling wedge is often a bullish reversal pattern. If on-balance volume is rising as the price forms a falling wedge, it indicates increasing buying interest and strengthens the likelihood of a breakout to the upside. Another useful chart pattern to consider with on-balance volume is the rectangle pattern. Rectangles represent periods of consolidation where the price moves between support and resistance levels. If on-balance volume is trending upwards while the price is in a rectangle, it suggests that accumulation is taking place and a breakout to the upside is more probable. If on-balance volume trends downward during the rectangle formation, it suggests distribution and a potential breakdown. For traders looking at reversal patterns, head and shoulders and inverse head and shoulders are powerful when paired with on-balance volume. In a head and shoulders pattern, if on-balance volume begins to fall significantly as the right shoulder forms, it serves as a strong indicator that a downward reversal is likely. Conversely, in an inverse head and shoulders pattern, rising on-balance volume during the formation of the right shoulder adds confirmation to the bullish reversal potential. Also, be on the lookout for double tops and double bottoms. A double top with decreasing unbalanced volume suggests that the buying pressure is weakening, which increases the likelihood of a downward move. Meanwhile, a double bottom with rising unbalanced volume indicates that selling pressure is waning and that buyers are starting to gain control, pointing to a potential bullish move. These chart patterns, when combined with unbalanced volume, help provide a more complete picture of market sentiment and can improve your ability to anticipate future price movements. Always use unbalanced volume in conjunction with these patterns to add further validity to your trading decisions and gain deeper insight into the underlying buying or selling pressure. To effectively use unbalanced volume, it is crucial to understand how different chart patterns interact with this indicator. For instance, if you notice a rising wedge pattern while the unbalanced volume is decreasing, this can be an early signal that the price might break down soon. Conversely, if you see a falling wedge while unbalanced volume is rising, it could indicate a potential bullish breakout. Another powerful pattern to look for is the symmetrical triangle. When a symmetrical triangle forms, pay attention to the direction in which the unbalanced volume moves. If the price breaks out of the triangle and the unbalanced volume also starts moving in the same direction, it is a strong confirmation of the breakout's validity. Ascending triangles can also be significant when analyzed with unbalanced volume. If an ascending triangle forms and unbalanced volume starts to climb, it suggests that buying interest is building up, potentially leading to a strong breakout to the upside. Additionally, consider head and shoulders or inverse head and shoulders patterns. For a standard head and shoulders pattern, if unbalanced volume starts declining after forming the right shoulder, it adds more weight to the idea that a reversal is imminent. In the case of an inverse head and shoulders, rising unbalanced volume during the formation of the right shoulder can indicate that a bullish reversal is likely to happen. Look for double tops and double bottoms as well. A double top that forms while unbalanced volume is declining signals a possible downturn as selling pressure is increasing. On the other hand, a double bottom that forms with increasing unbalanced volume is often an indication of strong buying interest, pointing towards an upcoming bullish move. Finally, pay attention to consolidation periods such as rectangles or flags. If the price is consolidating in a rectangle and unbalanced volume is gradually trending higher, it indicates that accumulation is happening during the consolidation phase, suggesting a breakout to the upside is likely. Similarly, if a flag pattern forms and unbalanced volume continues to rise, it can be a sign that the preceding trend is likely to resume. When using unbalanced volume, combining it with these chart patterns provides a comprehensive view of both volume and price action, allowing you to identify potential trade opportunities with greater confidence. Always check the unbalanced volume alongside the price patterns to get a better sense of where the market may be headed next. When using unbalanced volume, it is helpful to also look at different chart patterns that can confirm or contradict what unbalanced volume is showing. For example, if you notice a double bottom or head and shoulders pattern forming while unbalanced volume is diverging from the price, this could be a strong signal of a reversal. Unbalanced volume can also be paired with trend lines to confirm breakouts. When price breaks through a trend line and unbalanced volume follows suit, it adds further strength to the signal. This can give you more confidence that the breakout is genuine and not just a temporary spike. In addition, watch for consolidation periods. During these times, unbalanced volume may move sideways even if the price fluctuates slightly. This is a sign that the buying and selling pressure is balancing out. A sharp move in unbalanced volume following a consolidation period can indicate the beginning of a new trend, especially if it aligns with a chart pattern like a triangle or flag breakout. So, the next time you are looking at a potential trade, check the unbalanced volume, combine it with chart patterns, and see if it is confirming the trend or signaling something else. The next indicator we are going to talk about is the volume-weighted average price. The volume-weighted average price is a tool that helps us understand the average price of a stock throughout the day, with volume factored in. The average price is plotted as a line on the chart, and it shows where the bulk of the trading has occurred in comparison to the current price. If the price of the stock is above this line, that generally means buyers are in control. When the price is below the volume-weighted average price, sellers are in control. You can use this to identify potential support and resistance. Traders like to use this to help determine whether a stock is overvalued or undervalued during the day. It is also helpful to consider the chart patterns that form around the volume-weighted average price line. For example, if you notice a flag or pennant pattern forming near the volume-weighted average price, it can give you clues about the next potential move. If the price breaks out of a flag pattern above the volume-weighted average price with strong volume, this is a solid indication that buyers are taking control. Similarly, a head and shoulders pattern forming below the volume-weighted average price may signal an impending sell-off. Another useful pattern to watch for is the cup and handle. If this pattern forms and the price is consolidating near the volume-weighted average price, the breakout from the handle can often indicate a significant upward move, especially when accompanied by rising volume. Additionally, traders often look for double tops or bottoms in relation to the volume-weighted average price. A double bottom pattern with the second bottom forming above the volume-weighted average price can be a strong buy signal. On the other hand, a double top pattern forming below this line can be a warning of more downward pressure to come. When you see the price cross above the volume-weighted average price with strong volume, that might be a good opportunity to go long or buy. If it drops below with heavy volume, that could be a sell signal. This indicator is especially useful if you are trading during the day and you want to see where most of the activity has been happening. Combining the volume-weighted average price with chart patterns such as triangles, flags, or head and shoulders can greatly improve your ability to identify high-probability trading opportunities and make better decisions. Next up is something called the accumulation and distribution line. This indicator measures the flow of money into and out of a stock. It takes both price movement and volume into consideration to help us figure out if a stock is being accumulated or distributed. If you see the line going up, that means the stock is being accumulated, which is a sign that buyers are becoming interested. If the line is going down, it means the stock is being distributed or sold off. One of the best ways to use this indicator is to see if the accumulation and distribution line matches the price trend. When they are both going up, that is a good sign that the trend is solid. However, if the price is going up but the line is falling, that might mean the rally is running out of steam. Additionally, consider looking for classic chart patterns such as double tops, double bottoms, and head and shoulders in relation to the accumulation and distribution line. For instance, if a head and shoulders pattern forms while the accumulation and distribution line is trending downward, it could indicate an upcoming reversal. Another effective use of this indicator is to watch for divergences. Divergences occur when the price is moving in one direction, but the accumulation and distribution line is moving in the opposite direction. For example, if the price is making higher highs, but the accumulation and distribution line is making lower highs, this can be a warning sign that the upward trend is weakening and a reversal might be imminent. Similarly, if the price is making lower lows while the accumulation and distribution line is making higher lows, it could indicate that accumulation is taking place and a bullish reversal may be on the horizon. Also, pay attention to consolidation patterns. If the price is in a consolidation phase and the accumulation and distribution line is trending upwards, it could mean that accumulation is happening during the consolidation, suggesting a potential breakout to the upside. Conversely, if the price is consolidating and the line is trending downward, it may indicate distribution and a potential breakdown. Keep an eye on this to help confirm trends or spot when the trend might be weakening. Now let us move on to the Chaikin money flow indicator. This is another volume indicator that helps us see whether there is buying or selling pressure over a certain period. When the Chaikin money flow value is positive, that suggests there is buying pressure. When it is negative, there is more selling pressure. If you see the Chaikin money flow cross above the zero line, that can be a buy signal. If it crosses below, that can be a sign that it is time to sell. It is a great way to confirm the strength of a price movement. If the price is rising but the Chaikin money flow is negative, that could mean the rally is weak and may not last. This is a handy tool if you want to gauge whether the market is bullish or bearish at any given moment. Next, let us discuss the volume oscillator. The volume oscillator compares two different volume moving averages. One is short-term and the other is long-term. This gives us a sense of whether volume is increasing or decreasing. When the volume oscillator is above zero, it means that the short-term volume is higher than the long-term volume. This can be a sign that momentum is building. If it is below zero, it means the volume is decreasing, which might suggest a trend is slowing down. It is also very helpful to consider various chart patterns when using the volume oscillator. For instance, if you see a rising wedge pattern forming while the volume oscillator is above zero and continuing to increase, it could be a sign that buying momentum is gaining strength. Conversely, if a falling wedge pattern is forming while the volume oscillator is moving below zero, it may indicate that selling momentum is decreasing and a potential bullish reversal could be imminent. Another useful pattern to watch for is the triangle pattern. When a triangle pattern forms during a phase where the volume oscillator is climbing, it often indicates a strong breakout is on the horizon. The direction of the breakout will often depend on whether the price action is forming an ascending or descending triangle. An ascending triangle combined with an increasing volume oscillator is a bullish signal, while a descending triangle with a decreasing volume oscillator could indicate continued bearish momentum. Pay attention to head and shoulders patterns as well. If a head and shoulders pattern forms and the volume oscillator shows decreasing volume, it can indicate that the momentum behind the trend is weakening, suggesting a potential reversal. The same applies to inverse head and shoulders patterns when the volume oscillator shows rising volume, which can indicate a strong bullish reversal. Finally, look for double top and double bottom patterns. If a double top forms with a declining volume oscillator, it strengthens the likelihood of a reversal as it indicates waning buying interest. A double bottom forming with a rising volume oscillator can confirm a potential bullish move as it suggests increasing buying interest and momentum. These chart patterns, when used alongside the volume oscillator, can help you identify not only the current momentum, but also the strength behind upcoming moves, allowing you to make better informed decisions. This can be very useful for identifying changes in market momentum, so you can decide whether to stay in a trend or get out before it weakens. Now, we will talk about the Market Facilitation Index. This indicator measures how efficiently the market is moving based on price changes and volume. When both the price and volume are increasing, the Market Facilitation Index shows that the market is moving efficiently and that buyers and sellers are actively participating. If the price is moving up but the volume is dropping, it could mean that the move is running out of steam and that a reversal may be coming. Use this indicator when you are looking to confirm whether a breakout is real or just a temporary move. It gives you a good sense of whether the market is still strong or starting to weaken. Let us continue with the Money Flow Index. The Money Flow Index is similar to the Relative Strength Index, but with a twist. It uses both price and volume to tell us if a stock is overbought or oversold. If the Money Flow Index is above 80, it suggests that the stock is overbought and might be due for a pullback. If it is below 20, it means the stock might be oversold and could be due for a bounce. When using the Money Flow Index, it is also important to consider the chart patterns that accompany the readings. For example, if you notice a double top forming while the Money Flow Index is above 80, this could indicate an upcoming reversal. Similarly, if you see a double bottom forming while the Money Flow Index is below 20, it can signal a potential bullish reversal. The Money Flow Index can be particularly useful when it diverges from the price. If the price is making new highs but the Money Flow Index is not, it could be a warning that the uptrend is losing strength. Conversely, if the price is making new lows but the Money Flow Index is not, it may indicate that the downtrend is weakening and a reversal could be imminent. Head and shoulders patterns can also be powerful when used in conjunction with the Money Flow Index. If a head and shoulders pattern forms and the Money Flow Index starts to decline from an overbought level, it adds further confirmation that a reversal is likely. On the other hand, an inverse head and shoulders pattern forming when the Money Flow Index rises from an oversold condition can be a strong bullish signal. Additionally, watch for consolidation patterns like triangles or flags. If the price is consolidating while the Money Flow Index remains high, it might suggest that the buyers are still in control and that a breakout could happen soon. If the Money Flow Index starts to drop during a consolidation, it could indicate that buying interest is fading and a breakdown might be more likely. Traders use this indicator to spot reversals or to confirm whether a trend will continue. It is great for timing entries and exits because it gives you an idea of both the price momentum and the underlying volume, especially when combined with classic chart patterns to provide a more comprehensive trading signal. Finally, let us look at the price and volume trend indicator. This is similar to the on-balance volume indicator, but instead of adding or subtracting the entire volume, it only adds or subtracts a percentage based on the relative price change. This indicator can be helpful for confirming whether price movements are being supported by volume. When the price and volume trend is moving up, it confirms that the bullish trend is strong. When it is moving down, it shows bearish pressure. Watch for divergences between the price and volume trend and the actual price, because this can indicate a possible reversal. Let us recap what we have learned so far. The best indicators for volume analysis include on balance volume, volume-weighted average price, accumulation and distribution line, check-in money flow, volume oscillator, market facilitation index, money flow index, and price and volume trend. These indicators can help you spot trends, confirm breakouts, and time your trades more accurately. My suggestion is to start by incorporating one or two of these indicators into your trading strategy. Try them out and see how they help you make better trading decisions. Volume analysis is an important part of any successful trading strategy. Using the right indicators can give you an edge and help you understand what is really happening behind the price movements. I encourage you to keep practicing and keep learning. The more comfortable you get with these tools, the better your trading decisions will be. Remember that every great trader started somewhere, and the key is to stay curious and stay engaged.